Hello, Namaskar viewers. I am Sanjeev Pandya welcoming you to this week's episode of the Tech Talk with Mr. AJ Kumar. The show is brought to you by Science CPA Services, a full-fledged professional, a complete accounting firm located in the state of New Jersey, multiple locations, but you can reach them wherever you are in the USA. You can give them a call at 908-888-8900 or visit their website, sciencecpaservices.com. For your personal taxes, business taxes, or any tax related matter, Science CPA Services can assist you and can also navigate you in the right direction. I know we are only in the month of July, but taxes are taxes. And the next month and a month after, September and October, some taxes are going to be due. So that is exactly the reason is that you need to contact Science CPA Services and set up a meeting with them, have them review your tax status, and they will, like I said, that they will make sure that you file your taxes right. Once again, you can give them a call at 908-888-8900. With that note, I'd like to welcome Mr. AJ Kumar of Science CPA Services to the show. He brings over 25 years of experience when it comes to tax accounting and business-related matters. AJ, good to have you.
Thank you, Sanjay. Thank you for the kind introduction. And you're right. Even though it may be too early for some people when it comes to taxes, but we have a tax deadline for all businesses who filed the extension. September 15th is the tax deadline. For individual people who filed an extension, October 15th is the tax deadline.
Awesome. September 15th and October 15th. So that's where we are. So that's the tax deadline that I was referring to it. Now, like I said, taxes are taxes. But today we're going to touch upon the subject. The matter is the millionaires taxes, because when you are, $1 million worth individual, when your net worth is million or above, there are certain strategies that applies to you when you file your tax return. So AJ is going to walk us in a couple of strategies, couple of options that what millionaires tax should look like and what millionaires should do in that situation. So AJ, millionaires, of course, they have to file a tax return, and they can also save money by doing some things. And when I say save money, in the sense, the tax liability, correct?
Absolutely, 100%. So more money you make, more taxes you end up paying, meaning more exposure you have. So it goes a long way to plan in advance, especially when you have lot on the line, especially when you are in high net worth type of situation. A little bit of tax planning goes a long way. So there are several strategies, Sanjeevji, 16 strategies that we typically use when it comes to the high net worth clients. In this episode, we'll pick up a couple of them. We'll pick up 3.
But then I have a question. Please. You say 15, 16 strategies. Do all the strategies apply to any single taxpayer, or only some of them will apply to them?
Well, not one tax strategy applies to everybody.
Oh, okay.
It depends on a lot of factors. It depends on active income versus passive income. It depends on real estate exposure versus non-real estate exposure. It depends on what type of business they have, flow-through entity, non-flow-through entity. It also depends on how much income they have. It also depends on the source of income. Is it W-2, 1099, consulting, dividend, royalty? So all these tax strategies are meant for somebody. Not all strategies are meant for everybody.
Okay.
So based on the situation that we are giving, that we are handed, we look at all the strategies that we have in our hands, and then we see what applies best. What can we do best in this situation to bring the tax liability to the lowest possible point?
All right. So not everything applies to everyone. Okay. So let's start with monetizing installment plan, one of the strategies.
Absolutely. So the concept here is when you are selling a business, an asset, a real estate. Typically, the way it works, you buy something for $100, you sell it for $1,000, so you pay tax on $900. This is how it's typically done. And in more likely than not, this $900 is a lot of money in this situation. It pushes you into high income tax bracket, because this is additional money, because you just sold something. You had the regular income and now you sold something, and it created large amount of income for you. So how about you were to sell the same asset, but not in one transaction, but in installment sale? What I mean is, instead of selling it for $1,000, I sell it for $100 a year for next 10 years. Now the income tax bracket is going to be lower. The only downside is you don't have the cash flow now. You don't have access to the cash flow. The cash flow that you were supposed to get, in our first example, you bought something for $100, you are selling for $1,000, you got $1,000 now. And you need the money now. You want the maximum cash flow now. That's the only reason you are selling it. But when you sell it in installment, you don't get the same cash flow for n number of years. So what you do, you turn around, you go about monetizing this installment sale agreement. So when you are selling something, selling an asset on installment sale, there is a legal contract around it. There is a contract that says that this person is expected to pay you $100 every year for next 9 years. In this example, you can take this installment agreement to any bank and take a loan against this installment agreement.
Okay.
This is called collateralizing. You can collateralize this installment agreement and take up to 70% loan from any bank, because the bank sees it as a guarantee which is backed by the asset. It's an asset-based lending from the bank perspective. So they will be happy to give you up to 70%. So you got 70% of this $900 plus $100. So you got a lot of money upfront. You got the cash flow upfront. The best part, the loan is not taxable to you. So the money that you got by monetizing this installment sale agreement, that loan amount is not taxable to you. So you got the cash flow and you only pay tax on $100. You only pay tax on the installment amount.
Okay.
So the concept is referred as monetizing the installment sale agreement.
All right. So once you do that, once in that situation, does capital gain tax apply anywhere in this situation?
Well, that depends on the transaction. When you are selling an asset, typically you have capital gain if you kept that asset for more than 1 year.
Correct.
It could be business, it could be physical asset, property, but if you bought the property 5 years ago for $100, now you are selling it for $1,000. So you have long-term capital gain of $900 in this example. But the idea is, do you have to pay tax right now on this $900, or is there a way for you to get the cash now and pay the taxes over next 9 years?
Okay. Yep.
Differing the tax liability.
Different the tax line.
Not only you pay later, meaning in next 9 years, just because your additional income is $100 only per year, your income tax bracket is going to be much lower.
Okay. Understood. How does the loan repayment works in this situation? Since you mentioned loan several times.
Absolutely. So first thing, loan is not taxable. So you're taking the loan from the bank by monetizing the installment sale agreement. Now you're taking 70% of the loan from the bank. So every year you get $100 from this buyer that you sold the asset to, and then this $100 goes to the bank, and $70 goes to the bank, and $30 comes to you. So automatically every year the buyer pays you the money, it goes to the bank. Bank will try to collect the money directly, and some of the money comes to you. 70% of the money in this example goes to the bank.
Okay, very good. So that is basically all the details that you can share with us when it comes to monetizing installment plan for the millionaires, on their tax return.
It's more about collecting the tax now without actually paying, without collecting the cash now, without actually paying any taxes now,
yes.
while the taxes will be paid in the future years.
Okay, so when you defer these taxes, is there a time limit that you deferred it for 5 years, 7 years, 9 years?
It depends on the duration of the installment sale agreement.
Okay.
The installment sale could be for 5 years, could be 10 years. Longer the duration, lesser taxes you pay, because first you are deferring it for that period. Second, longer the period means smaller the installment amount, meaning lesser income tax bracket you are going to have.
Okay, all right. So that's a monetizing installment plan. That's one of the strategies that AJ gave us information on it. Now let's go to the next strategy, which is also very popular. It's called captive insurance. Shed some light on a captive insurance. How does that work for millionaires tax?
Absolutely, my pleasure. So a captive insurance is a concept where the insurance company is captive, is exclusive to your business. But please understand, before I give the details, you remember, captive insurance has been one of the top 10 tax scam on the IRS list. This captive insurance is probably one of the most misused concept. So if you understand this concept, you can save a lot of money, but make sure you understand it and you don't implement it yourself. There is high scrutiny just because the plan, this captive insurance, can save hundreds of thousands of dollars, if not millions of dollars. The scrutiny is very high. So you have to have the right professionals, right people implementing this plan for you. There is a lot of scrutiny around it. Now let's go to the concept here. In a captive insurance, you create your own insurance company. So let's say you have a business, you have a grocery store. You have to buy a lot of insurance around it. You have to buy general liability, you have to buy product liability, you have to buy several different type of insurance around this business that you have, the grocery store. And when you pay the insurance premium, this becomes an expense for your business. And the insurance company may have to pay the bill if there is a claim, may not have to pay the bill if there is no claim. If the insurance company does not pay any claim, it becomes profit for the insurance company. So what if you create your own insurance company? You pay X amount, let's say if you pay $50,000 every year to this insurance company. Since it's your own insurance company, you're not putting any claim anyway. The $50,000 that you're paying to the insurance company becomes an expense for your business. In this example, for the grocery store, the insurance company keeps collecting $50,000 every year. It's sitting there. You can invest this money, but nobody is claiming this money because you wouldn't be putting a claim against your own insurance company.
Because the owner has the greater control. Owner has the full control on that insurance company, right? On
Owner
that insurance
owns
program.
the insurance company.
Yeah.
The owner who owns the grocery store, in
Correct.
this
And
example,
they have the greater control.
he owns the insurance company as well.
Okay.
So he will not be putting any claim against his own insurance company.
All right. So we're going to stop right there. He will not be putting any claim against his own insurance company. That's where we're going to stop. Viewers, we're going to take a break once again. And the strategies, the captive insurance, will continue to give more details on it right after this messages. Welcome back to the second half of the Tax Talk show with AJ. And moving on to our show now, the topic is the millionaires tax and how they can save their tax liabilities by using one of these strategies. Earlier, before the break, we talked about a maximum installment plan, right?
Monetizing
installment plan, then the captive insurance, and now we're going to continue more on captive insurance from Mr. AJ Kumar.
So the concept we're discussing regarding the captive insurance, that you have your own, meaning the owner of the grocery store owns another company, insurance company. The premiums are paid to the insurance company. So premiums that are going out of the grocery store, they become tax deductible expense like any other insurance expense that you have. The insurance company keeps accumulating the insurance premiums, and then after a certain number of years, after 3 years, 5 years later, you close the insurance company, you only pay long-term capital gain. Now the tax arbitrage, the tax saving is, when you get the saving at the grocery store, you are saving 37% taxes because it's a regular expense, regular deduction for you. When you pay the taxes by dissolving the insurance company, you only pay long-term capital gain. So it creates, which is 20%. So it creates a tax arbitrage where you save 17%. Now, in reality, this is the concept here. You save 17% by creating your own insurance company. Now, why does not everybody have it? Why can't you and me have this insurance company? Setting up the insurance company cost about $60,000 to $70,000. Then there's a running cost. So unless you are saving at least $100,000 in taxes, it doesn't work. It does not make sense. Now, the tax arbitrage is 17% only. So in order for you to save $100,000, you have to be, your insurance expense has to be at least $600,000. 17% of 600,000 is 102,000. So in order for you to save 100,000 by creating the tax arbitrage, moving the taxable income from 37% to 20%, 17% saving, you have to be investing at least 600,000 in insurance expenses to have the real benefit. So the concept is there. It's highly scrutinized. IRS checks these concepts thoroughly. You have to be covering the risk that's not normally covered in the market. And it's only applicable, it only makes sense when your insurance expenses are very high, at least $500,000, if not more.
Okay.
That's the concept behind captive insurance.
So what's the difference between captive insurance and traditional insurance?
So traditional insurance will typically cover general liability, error and omission, workers' comp. Captive insurance covers the risks that are not covered in the market. Take an example. Let's say I'm an accountant. I sit 14 hours. If I keep sitting 14 hours, I'll gain weight. If I gain weight, I get cranky. When I get cranky, I start yelling, I lose customer, I lose employees. Now, there is a definite risk of losing business for me to get heavier, to gain weight, to get fat. Now, there is no insurance company that will insure against me getting fat. So, but it's a genuine risk for my business. I create my own insurance company for a risk that's not covered in the market. And how much insurance premium do I want to pay? There is almost 100% chance for me to gain weight. So the premium has to be high. The insurance premiums are decided by the probability of having to have that event. When you have an event that's going to happen 100%, the premiums are going to be very high.
Exactly.
So I decide the premium is $500,000 for me to get fat. The insurance company, which is owned by me, is charging a premium of $500,000 to my business. This $500,000 paid to the insurance company is a tax deductible expense for me, only because it's a regular expense. Insurance premium is an expense. Nobody claims against this premium. Insurance company keeps collecting $500,000 every year. After 3 years, I dissolve the company, take $1.5 million, nobody claimed, and this $1.5 million comes back to me at long-term capital gain tax rate of 20%. So I saved 37%, but I had to pay 20% only when I got the money back.
So is there real money transaction involved between you and your insurance company, your own insurance company, that you pay annual premium, and then at the end of the 3 years you literally take out that 1.5 million?
That's where the scrutiny is. A lot of people were trying to just create the journal entry that I owe you type of note, as opposed to actually money going there, because it blocks the cash flow.
Yeah.
You can always take the loan from the insurance company, but the premium has to be paid out. You have to really show the cash transfer from your regular business going to the insurance company. Then this insurance company can loan the money back, or can invest the money in the market, can invest the money into the stock. I mean, that's the money that it doesn't have to be sitting there. You have the option, the right to invest it, but the cash outgoing transaction and incoming transaction must be there.
So somebody can pay $500,000 premium on December 1st, and then come January 25th, they can take out that money, $500,000 as well.
As a loan.
As a loan, of course. And
As
then
a
they would
loan.
have to pay back in that year $500,000 plus another $500,000 premium, $1 million. Okay, so that's a captive insurance. You think it's a really popular thing? You did say that
It's an
people are taking
extremely-
advantage of it.
It's extremely popular among certain income tax bracket, certain people, and this has been, and even now has been, one of the top 3 highly misused tax plan in this country. They call it dirty dozen, IRS dirty dozen. If you put it on internet, IRS dirty dozen, you will see captive insurance consistently in top 3.
Very good. Okay, so that's the detail on captive insurance. Now let's go to the third strategy, which is called 1031 exchange.
Absolutely. So this is a scheme. As captive insurance was meant for people who could afford $500,000 of insurance expense, meaning really high net worth client, this 1031 exchange is meant for everybody. It's meant for people like me and you, people who are making 50,000, people are making 500,000. So 1031 exchange, the concept means that you, when you sell a property, you don't really show the proceed as a taxable gain. You use those proceeds to buy yet another property. You have to identify the property in 45 days. You can identify more than one property. You have to close the deal within 6 months. You cannot use the proceed. You have to use the whole proceed. Let's say if you bought something long ago for $100,000, it became $500,000. Now you have to pay tax $400,000 on capital gain tax. But how about you reinvest this $500,000 into another property? There are rules around it. You have the closing has to happen in 6 months. You cannot touch the money. The money must remain in the attorney's escrow account. So again, there are rules around it. The concept is if you reinvest the money, you don't have to pay the capital gain tax. The question that we are asked typically, eventually, you sell the second property. Eventually, you sell the third property. How many times can I do the 1031 exchange? Sooner or later, I have to pay the taxes. But that's where the concept differs. And the concept is referred as swap till you drop. What it means is, at the end of the life cycle, you give this property to your next generation. When you get the next generation gets this property, they get this property at the market value, not at the cost basis that you paid.
Correct.
As part of the inheritance rule, when the inheritance is received by the next generation, is received at the market value. So you never
Never have
not
to pay
you,
tax.
not your next generation,
have
you
to pay
never
tax.
pay taxes if you implement the 1031 exchange strategy properly.
But then you really have to hold on to it till next generation is able to pick it up on their
A lot
own.
of people can, a lot of people do. They just don't know. They keep paying the taxes,
So-
and taxes are very high. I mean, as much as 30%. Consider a situation 1/3 of the money is going out of your pocket.
All right. So 1031 exchange, it sounds like that's mainly for real estate investors.
It could be for anybody. Right now, it's for real estate investor.
But could be for anybody in sense a person has invested into real estate and properties.
Absolutely.
Okay.
Absolutely.
All right. So with that note, we come to the end of this week's episode. This was about millionaires tax strategies. We discussed 3 of them: monetizing installment plans, and then captive insurance, and then last one was 1031 exchange. There'll be more coming your way also in the coming week. But 2 weeks from today, I should say July 30th, there is going to be an event at ITV Gold Auditorium. It's all about millionaires taxes and their strategies, where Mr. AJ Kumar will address the audience and will show them where and how millionaires can save money by using any one of those strategies. So it's going to be a very interesting event. You should look at the flyer that you will see it on the screen, and do contact them and be part of that event. It's definitely all the information is on the flyer. So be part of the event. With that note, we come to an end of this week's episode. AJ, thank you so very much.
Absolutely. Thank you. And next week, we'll discuss some more strategies for millionaires tax success formula.
Sure. I'm Sanjeev Pandya. Until we meet again, same place, same time, for another episode of the Tax Talk with AJ, sponsored by Science CPA Services. You do take care, and so long.
Thank you.